Hello again, everyone. This is Greg Towner with Parallel Financial. Welcome to the July Market Outlook call. Now, this month, we're going to go ahead and again look at the market price trends that we always like to start off with. We want to look at some of the characteristics of this current market and see how they compare not only to the past, but also to international markets today. And then we want to look at the seasonal tendencies that might be upcoming in the current markets. So let's jump right in. When we look at the S&P 500, as we've been pointing out for a number of months now, strong price trends moving higher with both the red 200-day average, the 50-day average in green, just general uptrends, even has taken a little bit spike higher since we spoke last month. Of course, we've talked a lot about international markets. Many of them are the top performers so far this year. And we think that is, partly because of this price trend remains healthy. You can see uptrending, had a bit of a correction last month actually, but has regained most of that and still performing well in the broad international developed markets. Where we've seen a lot of strength recently is the emerging markets. That's continued to be a strong price trend, and then really over the last month has surged higher. Of course, you could argue maybe it's gone a little bit fast, but for the most part, emerging market trends are quite strong. So this leads some investors to wonder, okay, things have gone quite a bit higher, pretty fast. How does this make us feel about things? Well, we thought it might be interesting to take a look at some of the characteristics of the market today compared to a couple other major points. So for example, you may remember the major market tops in 2000 and 2007, and here we are today in 2017. So back in 2000, market was trading at a forward PE ratio of over 27. In 2007, almost 16. Today, around 17 and a half or so. So certainly much less than we were in 2000, and a little bit above 2007. About dividend yield. We go back to the March 2000 top, barely 1% you were getting on a dividend yield for the market. 1.8 in 2007. Today, a little bit over 2. So not huge, but certainly more attractive than the previous two major market tops. And the 10-year treasury. So when you look at investing, a lot of your choices are your decisions between different asset classes, stocks versus bonds and cash and so forth. Well, you can see back in 2000, you could actually lock in a 10-year treasury for a nice over 6% rate. In 2007, nearly 5%. But today, even with a little bit of move up in yield this year, only 2.3%. So you'd have to lock up at 2.3, that's roughly equal with the dividend yield, and we would expect that dividend yield to grow over time. So the U.S. market right now, while it's not dirt cheap by any stretch, it does compare reasonably favorably compared to certain points over the last 20 or so years. We've talked a lot about international, so how does the U.S. compare and its characteristics compare to international? So the purple line here is a broad international developed market. You can see that the U.S. PE, as represented by the S&P 500, a little bit over its 20-year average, not significantly so, but modestly over. Whereas the international market is actually below its 20-year average and well below the S&P right now. So good value in international. As far as dividend yield, U.S. average is about in line with its 20-year, whereas the international is actually above its 20-year and well above the U.S. So you're getting good value and good dividend yield from international. Now that brings us to the last topic for this month. We wanted to look at a little bit of the seasonal tendencies. We're midway through the summer now. You can see by this green bar that July, going all the way back to 1928, has been really about the strongest month. I think that would surprise people. But as we get later into the summer, tends to be some seasonal weakness late in August and then certainly September, the worst month by far. On average, of course, doesn't mean it's always going to be that way. And when we look at actual volatility as well, this is a measure of volatility over all the trading days throughout the year. You can see through much of the year it stays relatively consistent, a few spikes here and there. But then as we get into the mid-third quarter, August, and then into September, you start to get a little more volatility before it calms down later in the year. So seasonals aren't something that we make big long-term bets on by any stretch. We wouldn't encourage you to make any rash decisions. It's just something to keep in mind so that when volatility does pick up, because volatility has been extremely low lately, when and if it picks up, just remember, hey, that's a reasonably normal thing. It's just important to always have your normal risk management plan in place. So in summary, where does that leave us? Well, market action as far as the price trends remain very healthy. US markets, we think, are compared reasonably well to their history, and international markets are very favorable both to their own history as well as to the US right now. Seasonal tendencies, again, something to keep an eye on, something to be aware of, and know that if volatility picks up, that's a reasonably normal thing, but don't change any long-term plans for that. So thanks for joining us. We look forward to speaking to you again next month.